For that, we have assembled a team of very knowledgeable presenters. Digital currency is something that is of interest to the SEACEN Centre and something we think about a lot. So let me give you the running order of how we were thinking today's presentation would go. We'll start off with my colleague, Mark McKenzie, whom you all know, who will talk about an overview of Libra and basic setup, what we know about Libra so far, how it's going to work, governance, and so on and so forth. We are then joined by Professor JP Landau of the Sciences Po in Paris, and currently a visiting professor at the Harvard Kennedy School of Government. A big thank you to Jean-Pierre at this point. He's joining us from Paris, where it's 6 o'clock in the morning, and I hope he's got a big cup of coffee ready with him. And Jean-Pierre has thought a lot about the issue of digital currencies. In fact, earlier this year, he was asked by the French president to write a think piece, a consultative paper on this topic of digital currencies. He's also just last week published an NBER working paper on the digitalization of money, which I wholeheartedly recommend to you, co-written with Markus Brunnermeier, who needs no introduction, and Harold James, who's an economic historian, both of them at Princeton. The third person will be me, and I'll talk about the macroeconomic and monetary policy implications, or possible monetary policy and macroeconomic implications of Libra. And then last but not least, we have our colleague Aziz Durrani, who will talk about the regulatory implications. I hope that you've all read Aziz's blog post on this topic a couple of weeks ago, which kind of sets the scene for how we think about Libra at the SEACEN Centre. If not, Aziz's blog post is available on Swara SEACEN, and it's on the question of whether Libra heralds the demise of the US dollar as a predominant global reserve currency. With that, I think that's sort of introduction enough. Again, thank you, welcome to all, and thank you very much for joining us. And I'll turn you over to Mark to give us the everything we need to know about Libra, but we're afraid to ask.
Thank you very much, Dr. Ole. Ladies and gentlemen, this afternoon I intend to share with you in about 10 to 15 minutes an overview of Libra as was presented by the Facebook and its team in June. So what are the objectives of the Libra based on the paper that was presented in June? But it's essentially, they intend to launch Libra in the first half of 2020. Last week we heard that they may be pushing that date back. What problem do they intend to solve with this new digital currency? Simple, it's the financial inclusion, the unbanked problem that they're attempting to solve. They want to create enable a simple global currency and financial infrastructure that will aim to help the billions of people who are unbanked. And they quoted some numbers in their paper. So what are some of the key issues here in terms of purpose? One is to cryptocurrency or virtual assets, as we know them, are extremely volatile. So Libra, they want to have something that is, they said, will be much more stable than other cryptocurrency that we know. It will more or less be a financial infrastructure or a utility. It's designed as open source on the Libra blockchain. And I'm not going to speak much about the Libra blockchain other than the way it is set up now, or the way it is presented now. It is a permissioned blockchain, but in the paper, they have indicated that they have plans to move towards a permissionless blockchain. I'm only stating the facts from what has been presented. In our discussion today, we will speak about some of the issues. One of the key features that they presented in their white paper is the Libra Reserve. What is the purpose of the reserve? It is essentially a mechanism to support stability and value preservation. Essentially, what they have said is each coin that they issue will be backed by a basket of fiat currency. So essentially, they are hoping to get rid of the speculative component that we are accustomed to in other cryptocurrency or virtual assets. We can have some discussion around that later as well. There are some other key features of the reserve that is worth noting, and the paper on the Libra Reserve had 4 key questions that they used to explain the reserve. I'll try and go through these 4 questions. The first one is, where is the money in the reserve coming from? The second question is, how will the reserve be invested? Where will it be held? And what are the actual assets backing the reserve? So I'll just go very quickly through each of these questions. So where's the money coming from for the reserve? The money in the reserve is coming from two sources. So they have a group of committed members. I think right now in the Libra Association there are 28 members, and it's a list of all who is who in Silicon Valley. I'm sure my colleague Aziz will have something to say about that. Users of Libra reserves will actually have to use fiat currency. Sorry, users of Libra will have to use fiat currencies to acquire Libra. So essentially what they're trying to do is for each coin that is issued, there is fiat currency that will be backing. So in short, there is only one way to create more Libra, and that is by purchasing more Libra for fiat currency and to grow the reserve as well. How will the reserve be invested? Users of Libra Reserve do not receive a return from the reserve. It will be low-risk assets that will yield interest over time. So essentially, they're aiming to have things like government securities, short-term deposits, very liquid assets to use it. How will the reserve be held? They'll be held by a group of custodians. Those custodians will be selected by the Libra Association, and the thinking is it will be custodians with investment grade credit rating. They've identified some key parameters for selecting custodians, and that is in terms of safeguarding the reserve assets, high auditability, transparency, and they want to avoid the risk associated with centralized reserve and achieving operation efficiencies. What are the actual assets that will back each coin? It's, as I mentioned earlier, it will be bank deposits, government securities, and these will be held in stable and reputable central bank. So there's a basket of fiat currencies that will be held. The value of Libra will be linked to a basket of fiat currency, and the value, obviously, there will be some degree of fluctuation with a basket of currency, but the key objective is to preserve for capital preservation and liquidity within the reserve. So a key question then is, how do entities interact with the reserve? The first thing is, users will not directly interface with the reserve. To support a higher efficiency, there will be what they call authorized resellers, and the users will interact with these authorized resellers. A subject that my colleague will touch on is around consumer financial protection and law enforcement. The Libra White Paper was very clear in terms of its commitment to consumer protection, and especially as it comes to things like KYC and fraud and money laundering, etc. But we will raise some questions around this when Aziz presents as well. So these are just the facts as presented by Facebook and its associates. How will the reserve change over time? Logically, as it is backed by a basket of currency, there will be some kind of movement in the value of the reserve as there are changes in those in the value of those currencies that is backing the reserve. What's the size of the reserve? Well, this will be determined by the balances that users are holding in Libra. And it's simply whatever amount of Libra that is out there will have a value in terms of the basket of fiat currency. One of the points made in the white paper is that the supply of Libra will not be restricted by outside factors, and that this is really pointing to the Bitcoin, where we know that there's a limited supply of Bitcoin. All right, so they're saying that in this case, the supply will not be restricted by outside factors. And they're hoping that, like having the reserve, for example, in the basket of currency, these things will prevent run on the reserve as well. The last bit that I'll touch on is on the governance, and I'll do this very quickly. So in terms of governance, I mentioned earlier there are 28 founding members, and they're all who within the Silicon Valley. There is the Libra Association, which is an independent, not-for-profit entity that is HQ'd in Geneva in Switzerland. The mission of the Libra Reserve is really, as I mentioned earlier, to empower the unbanked community globally, the 1.7 billion people who don't have access to banking services. The role is to coordinate amongst the validator nodes, the effort to develop and secure the network to promote their joint vision of financial inclusion. So financial inclusion is clearly a goal of what they are trying to achieve. And they're also trying to achieve issues around, they will want to recruit new members within the association. And I think it is stated that they want to grow from the 28 founding members to 100 members, and they also want to move to a permissionless blockchain over time as well. So these are some important features in terms of governance. So who are the Libra Association members? They are global companies, they are banks, they are payment service providers, they are technology developers, they are academics. It includes also non-profit organization as well. There's a Libra Association Council, there's an executive committee as well. So these are all key features in terms of how Libra will be governed. An important question to ask around the governance structure is, what is the role of Facebook? Facebook is a mega global technology, social media, you name it, organization. So what role will Facebook play within the governance structure? In the white paper, it is stated that Facebook will maintain a leadership role to the end of 2019. But Facebook has created a subsidiary, which is called Libra, which will essentially be Facebook Wallet. As we know, they have WhatsApp and they have Messenger as well. So I'm suspecting that the wallet will be available within these platforms as well. One point that is made in the white paper is that when Facebook reduces its leadership role, it will be just one member amongst the initial 28 founding member. And remember, we mentioned that this group will grow to 100. So again, they're clearly saying they will have minimal role, but that's questionable, and that's something for my colleague Aziz will address as well. But one key point that we have to leave with, because this is the end of my segment, is that we have to bear in mind that it's not just that Facebook has a leadership role currently, but it's also that their engineers are instrumental in the development of this as well. So I will end at this point, and then we'll come back again. Thank you very much.
Great. Thank you, Mark, for giving us an insight into what Libra is, what Libra does. I think we're now very well equipped for the remaining parts of our presentation. We're taking a little bit of a step back and sort of thinking more broadly about the digitalization of money. And having introduced Professor Jean-Pierre Landau, I'm now asking Jean-Pierre to take over if he's at the end of the line.
I am indeed.
Oh.
I hope you can hear me. Yes. So thank you very much to colleagues at SEACEN for allowing me to make that presentation. I think the thrust of what I'm going to say is that it's no coincidence that a phenomenon like Libra is emerging right now. It is the product of technological evolution, which was bound to trigger such kind of initiatives. And I think we are only at the start of a process of emerging digital currencies worldwide. It has been actually very anticipated. And if you go back a few years ago, starting in 2011, 2012, there were a lot of commentaries that either Amazon or Facebook could launch their global currency by just using the power of their network. So it's not a total surprise. It is the product of technology. And what I'm going to try and reflect upon in this presentation is how technology right now is affecting the form and maybe the nature of money. So if we go to the first slide, the first thing maybe which is useful is to try and define what we could call as digital money. Clearly, we had money in electronic forms for many decades, or even almost a century. We had electronic money or e-money appeared like 20 years ago in advanced economy. So what is really new right now, and what triggers the power and the new form of digital money? What makes it specific? And I would think that there are two elements which, combined together, contribute to what is a digital money like Libra. The first thing, of course, is the internet. And the internet, with its cross-border nature, which with worldwide reach, and its ability to transmit information and bits of information instantly anywhere in the world. And on this internet, people are building protocols which creates so-called dedicated network or networks on the internet. Some of them are used for messaging, some of them are used for commercial, some of them, of course, are used as social network like Facebook. And so the idea of using a network such a digital network on the internet to build up a monetary architecture is pretty natural, because money is all about network, and money is based on network externalities, as we all know. So the emergence of the internet and networks built in the internet through protocols is, of course, a huge push factor to the apparition of digital currency. The second point, which is less well developed and maybe less well commented, in my view, which is absolutely crucial, is the possibility now to create digital tokens with value attached to them. So what is a digital token? It's basically an electronic file with some value attached to it and a name. And the progress of cryptography have made it possible to secure this sort of attachment of a value, a file, and a name. And then once it's possible, and if the legal framework is in place, then of course it's very easy to use such a file like this as a payment instrument and as money. You just access the file, you change the name on the file, and the payment has been made, basically. And so it's something which is relatively new, not the ability to create digital files, of course, but the ability to securely attach a name and change it through secure cryptographic means on an open network. That's very new. That has given rise to the cryptocurrencies themselves. And that, of course, is the characteristic of digital money. It is a digital token moving on the internet. Of course, the third thing, which is not mentioned on the slide, but which is absolutely obvious, is the mobile. The fact that we can store as many tokens as we want on our mobile, the fact that our mobile terminal is by itself part of a very broad network on the internet, makes it a totally different proposition from the forms of electronic money that we had 20 years ago, where you had to get a prepaid card or use your laptop to make payments for electronic money, which was extremely awkward and not very user-friendly. So to sum it up, the three things which coalesce together right now at this specific moment to produce the emergence of digital money is first the internet and protocol, second the mobile, and third the ability to create new payments instruments in a digital form without the digital tokens. A few words on the digital tokens. Of course, in money, we know tokens. In monetary theory and in monetary policy, we know what a token is. A token is a payment instrument which is exchanged on a peer-to-peer basis without a financial intermediary. So a banknote is a physical token. We exchange the banknote and finality is achieved, settlement is achieved. We can do that on a peer-to-peer basis and in anonymity, and the payment is made without any intermediary. So a digital token basically is a sort of e-cash, an electronic cash. We have exactly all the same properties. We can exchange value on peer-to-peer, except, of course, with two big differences with the physical token, which is the banknote. The first one is that to exchange a physical token, a banknote, we have to be physically close. And to exchange a digital token, we can be thousands of miles away and exchange it still on a peer-to-peer basis across border. That's a huge difference. That's a huge difference. And this is the reason why a phenomenon like Libra is emerging, right? Libra is providing e-cash cross-border. That is the innovation. And it's only at the beginning, as I said. And the second, of course, difference is the other way, is that the digital token must be registered somewhere. There must be a third party, which is not a financial third party, and which is a technical third party. There has to be a ledger where that digital token is registered, and where it does exist materially, in fact. Now, there's sometimes some confusion about the nature of that ledger, because all what is needed is a ledger. It can be a distributed ledger or a centralized ledger. It can be a blockchain or any kind of all ledgers. And sometimes there is a tendency of the promoters of cryptocurrencies to aggregate all these concepts and to let us think that you cannot have a digital currency if you don't have a blockchain or if you don't have a distributed ledger. Well, that's wrong. The form of the ledger is organizational and political choice that you make, whether you want a distributed ledger or not, whether you want it to be a blockchain or not. So that's one choice. But the other thing is the token itself, which is registered on the ledger, which is totally independent on the architecture of the ledger. It's very important to understand that, because sometimes the tech people and the developers, they tend to aggregate all those concepts in one block. And finally, of course, that technological innovation pushes us to revisit this whole distinction, which is very interesting, between account-based money and token-based money. So account-based money is the deposit money that you have in the bank, which is moved by the third party by changing the balances of your account and changing the balances of the account of your counterparty, which can only move through counterparty relationship between banks, and which by nature is a money which is a claim on the bank. Well, a token-based money is not a claim on anything. It's not a claim, sorry, on anyone. A Libra is not a claim on anyone, legally, I think. It doesn't need an account, and it can move without anybody knowing your identity, and it doesn't need a financial third party to effect the transaction, and it does not rest upon a counterparty relationship. So that's very important. When I move money through account-based money, I need a network of counterparty relationship. When I move money on a network through tokens, I don't need counterparty relationship. And of course, this is very relevant in cross-border transactions today, because as we all know, counterparty relationships in the cross-border transactions are very difficult to establish, are very difficult to maintain, and especially now with all the legislation on anti-money laundering and the fight against financial crime, we had, as everybody knows, a collapse or at least a significant shrinking of correspondent banking. And correspondent banking is, of course, based on counterparty relationship. So the emergence of a system of payments which dispense of counterparty relationship is a very powerful tool for innovation in principle, because it allows to circumvent all the frictions which are linked to a counterparty relationship in cross-border transaction. So that's the end of the first slide. Maybe we can move to the second. And what I would like here to develop is that this kind of token form of money, this kind of digital money, is compatible with a lot of different architectures in terms of monetary systems and monetary arrangements and payment systems. So here I have put two of them as example, which are the most frequently available today. So on the left, you have basically the less disruptive thing, which is what is called the wallet. So a wallet and what we call in the European regulation payment service provider is a system where a customer or user of a bank account delegates to an application or the manager of that application the ability to effect movement of on its bank account. So the bank account is there, the customer has a bank account, and it authorizes the application to intervene, to get access to the bank account, and to move money around and to effect transaction on the bank account. So it's very much still an account-based money system. It's very much a bank-based money system, and the token here is just used as a technical device, which is a mirror of the bank account on the mobiles, on the customer's mobile, so to give instruction to move the bank account. So it's a sort of very traditional thing, and most of the applications that we have on our mobile today, at least in advanced economy, and I guess in a number of large emerging economies, are of the wallet type. Now, if you move on the right-hand side of the slide, then you see that you can have a very different architecture where the customer themselves don't access their bank account. They have tokens which are issued by the e-money issuer. This is the system of electronic money. And the e-money, those tokens are directly exchanged between customers through their mobile application. And of course, the e-money issuer deposits the counterparty of their token either in a bank or in securities or in financial markets. Now, after having listened to Mark's presentation, you realize this is exactly what Libra is about. This is exactly what Libra is about. And it's the old scheme of e-money, which has been there for 20 years, but did not develop because the tokens were not sophisticated enough, and we didn't have the mobile, but which is going to develop enormously right now. And we have it in many emerging economies. This is, of course, the M-Pesa system in Kenya. This is developing in India, and this is basically the two big payment systems in China, Tencent and Ant Financial. They work on that principle. This is exactly the architecture that they have. Now it's becoming fashionable to call that a stable coin. These are tokens backed by financial asset or bank deposit or central bank reserves, but these are actually the schemes that e-money was about for the last 20 years. So e-money stable coins are just sort of two synonyms of this kind of arrangement. As you can see from this kind of arrangements, no, not yet, sorry. Can we just go back? As you can see from this kind of arrangements, the bank sits at the top, right? So there is still a bank, there is still money in the bank, but the bank has only one counterparty, which is the e-money issuer. So the big question is how those two models will articulate and develop in the future. At the moment, they coexist rather harmoniously. For instance, PayPal offers you the two models. You can have a PayPal account, which is basically what the right-hand side describes. You can have, or you can use PayPal as a wallet, which is basically what the left-hand side describes. So the two models coexist. And in China, for instance, people, of course, keep their bank account, and but they have tokens on their mobile, either tokens issued by Tencent or tokens issued by WeChat or tokens issued by Ant Financial. Now we can go to the next slide. And the one thing which is very interesting for the future is that digital money makes life without a bank possible, but not certain. So a lot, I think, for colleagues who deal with the future of banking banking regulation, competition in payment. A lot is going to be very interesting to see in the next 10 or 15 years whether mobile money, digital money, how it will affect the business model of banks, right? So again, if everything shifts to the right-hand side, the e-money stable coins model, the customer can live without a bank. And actually people in Kenya who use M-Pesa live without a bank. And it's going to be increasingly possible because we will have applications on our mobiles, apps on our mobiles, which will help us to manage our finances very easily, to move money around between the money market mutual fund, an asset management fund, and the tokens on our mobile. So technology will make it possible to manage a portfolio and to effect payments without a bank. That's what the token digital money offers. And again, if you go to the right-hand side of the previous slide, the bank is there on the top, but it's only a balance sheet which helps settle payments between the different e-money issuer, between the different stablecoins issuer. Life without a bank is possible. Whether it will happen depends on the number of factors, which I think is going to be very interesting. The first one is, I think, the competition between the credit debit cards and the mobile phones in terms of payments. It is developing, and it's very important because the credit debit card is a representation of a bank account. So a credit debit card is the way to use a bank account. Again, a mobile phone, mobile money can exist with or without a bank account. So the competition between credit and debit card will determine whether people will live or not with a bank account in the future. That competition is now, at least for everywhere to see. I think the development of mobile money has been a huge push factor for contactless payment that we see, at least in many countries, generalizing right now. So clearly, the issuer of credit and debit cards are trying to make the payments through card as easy and frictionless as payment with a mobile. It will, of course, depend on the development of fast payment system between the banks. And it's no coincidence, again, right now, that in Europe, in the US, the central banks are taking initiatives and in many emerging economies to develop fast payment system, because a fast payment system is an attempt, is a project to operate a counterparty relationship system as efficiently and as smoothly as a network token system. That's what fast payment is about. So we see all these technological innovations brought by digital money pushing for increasing efficiency in the traditional banking relationship, including cross-border, of course. And as Mark has mentioned, this is a major selling point for Libra to say that they will allow people who are unbanked and we have to send remittances and other cross-border small amounts of payments to operate much more easily. So the competition, the issue of the competition, and in my view, it's very uncertain. It's very interesting to watch, and it's very uncertain. We can think of one scenario of life without banks in 20 years, or we can think of a scenario where the banks will have adapted very much, issue themselves their own tokens, and still dominate the payment landscape. A second factor in that competition will be social attitudes and preferences. And I think the big question, which if I were a banker would keep me awake at night, is if you take young kids who are 12, 13, 14 years old today, who spend all their life with a smartphone, and whose life is totally organized around the smartphone. Once they have the possibility to have an independent financial life on the smartphone, will they still care about opening a bank account, right? That's one big question, and I think there's no answer to that question. It depends on social attitude and preferences. I think a lot of banks have seen that, and they're making online banking much easier for young people because they understood that is an absolute necessity. And finally, of course, there is the regulatory environment, which will decide ultimately on the issue of that competition between the token money and bank money. And I think it's going to be difficult to avoid a fundamental rethink of the regulation in that. Because at least in the countries I know, especially in Europe, all the regulation we have is actually based on the assumption that the high-tech companies are small actors, which should be helped to develop because they provoke banks into, they compete with banking payments and bring efficiency gains. Now, we see with Libra that high-tech companies are not small actors, they are big actors. It's very well understood in the latest chapter on big tech by the in the BIS annual report. And so competition in financial services will have to be fought, and regulation of competition in financial services will have to be fought as competing traditional banks versus big tech. And I think conceptually it's going to be very interesting, but not necessarily very easy. Maybe we can go through the next slide. So of course, networks, digital money allows for competition, and we see with Libra that we see emerging new global private digital currencies. So it's very interesting to think in conceptual terms whether the whole problematic of private money has been changed by digitalization. And I would say partly yes and partly no. So clearly what has been changed by digitalization is the ability for any kind of new currency to immediately gain broad acceptance and benefit immediately from large network externalities. Now, if I go back 150 years ago, if I were a bank in the middle of the United States or in the middle of Europe or in the middle of Africa, I wanted to create my new bank, my own banknote. Anybody who would accept my own banknote as payment would have to assume that very few people would accept it as payment themselves. And so it was very difficult to gain acceptance of a new payment instrument, of a new money instrument, because of simply physical obstacles and geographical distances. And of course, if you have network externalities, monetary instruments is attractive if attractiveness is closely linked to the number of people who are using it. Well, on a digital network, of course, you have hundreds of millions of billions of people who potentially will use that currency almost overnight. You know, so network externality will play full force immediately, whereas they would take decades to play in the past. And switching costs between currencies are going to be very easy because, as I said, we will all have apps on our smartphones, which will allow us to move money from one account to a token, from a token to an account. That is going to be very easy, very instantaneous. So the two things which in the past impeded the development of private currencies, which were no network externalities and high switching costs, those two things have totally disappeared in the digital economy. And that's the reason why we see those new private currencies emerging. Where I have more questions is on the other functions of money. What I said is, of course, very valid for money as a medium of exchange, and Libra presents itself as a medium of exchange. But there's no doubt that once a money has become a widely accepted medium of exchange, it will also become a store of value. And when it becomes a store of value, the whole very interesting from an economic theory point of view, the whole problematic of what determines its value, what determines its exchange rate against other monies, what determines its attractiveness for people is, of course, driven by very different factors than simply local externalities and broad acceptance. So without going deeply into the theory right now, the question of backing is important. This is the whole sort of economic corpus of theory about.
Professor?
Yes.
Are you still there? We're losing you a bit. I don't know if your mic is proper.
Is it okay now?
Yes, sir.
You want me to accelerate?
You're on time. You're on time. It's just like the volume went down. So.
Okay. So I was saying basically that as soon as a currency is becoming a store of value, the question of backing arises, and provided backing for a currency or a private issuer is going to be very tricky. And that's why Libra, I think, has adopted the system they have adopted. They are backing the currency by basically other currencies, which themselves are official currencies and backed by their own governments. So at this stage, at least, they have not taken the ultimate step of issuing an unbacked private currency. Now, when colleagues from central banks think about the future, they should think about possible scenarios in 5-10 years, if and when Libra is expanded, and then they could, being used by 1.5 billion people, let's give an estimated number, then they could think of releasing the backing, releasing the link with official currency, releasing the link with the reserves, as Mark explained, and becoming a whole sort of fiat private currency with their own monetary policy. That's a scenario which is not feasible today for them, clearly, but which is not totally unthinkable for the 1 or 2 decades. And when looking at what it means in terms of currency competition, I think this should be kept in mind. And this leads me to the next slide, which basically, since we are talking of cross-border network and cross-border currency, we have to think of their implication on the international monetary system, and that's a very big topic, and I think of major interest for central bankers in the future. So there are 3 concepts here which I think may be useful. The first thing is that when you take a network like Facebook and maybe in the future Amazon or whoever, so people inside the network are very close linked. They can exchange information between themselves very easily. They can get into contact very easily, and they have a form of money which they can exchange between themselves very easily, and much more easily than if they want to get outside of the network. It's already happening in China, for instance. If you have a WeChat application, you can exchange token with people who have a WeChat application, but you cannot exchange token with people who have a non-financial application, an Alipay application. So in a sense, although both currencies inside WeChat and inside Alipay are both denominated in renminbi, they are, in a sense, different currencies. There is some friction between them. And so a network where a digital token circulates is actually a sort of digital currency area, right? And if you combine to that, because transactions inside are much easier and with less frictions than transactions with outside. That's what defines basically a currency area. And if you combine that with the fact that all those networks provide an enormous amount of additional services, messaging services, e-commerce services, information services, platforms for exchanging, from which the currency is an integral part, you know. Then you have sort of ecosystem which develops, and this is clearly their business model, and that sort of increases the character of currency area that those networks are taking. So it's very important because the digitalization of money triggers the emergence, maybe, of currency area of a digital nature based on digital interconnectedness, which are cross-border. So the territories of national monies are sort of overpassed and circumvented by new digital currency areas. That's the first point. The second point, of course, is digital dollarization, and that's pretty clear. If those networks can allow people in your country to transact, to count, and to denominate contracts in monies which are not the national money. And digitalization makes it much easier to dollarize an economy which is based on bank money. Is possible. It's complicated, but it means the ability to open accounts denominated in foreign money. Here, it's done instantly. You have access to the network, and then you have access to a currency which is not the national currency. So if all the theory of dollarization applies here, and potentially a major threat for the autonomy of domestic monetary policy if it develops on a large scale. And finally, something which has been mentioned most recently by the governor of the Bank of England, Mark Carney, in his speech this summer in August at Jackson Hole, you can think of reshaping the international monetary system through what he called the new digital synthetic hegemonic currency. So he floated the idea that to remedy at the asymmetry of the international monetary system and the fact that it rests upon one major currency, the dollar, central banks or countries could think of constructing a new synthetic digital currency. He did not mention the SDR, but of course it comes immediately to mind that we have an existing basket of currency, which is the SDR, and creating synthetic SDR backed by official currencies, just like Libra is, would be, at least in theory, a possibility. So all this is a little bit speculative. All this is a little bit science fiction, but things are moving very fast, and I think it's incumbent upon us to sort of think one step ahead and try to think where this big movement of network plus digitalization is going to lead us. If I'm not mistaken, this is my last slide, Mark, no?
Yes, sir.
Thank you very much for your patience.
Thank you very much, sir.
Great, thank you very much, Jean-Pierre. You've given us a lot of food for thought. I would encourage everyone to have a look at some of the publications that are appearing on this slide. Professor Landau is a deep thinker on these issues, and in fact he provided me with a nice introduction to my theme. So Jean-Pierre, thanks again very much for getting up so early and talking to us today.
You are welcome.
Right, as mentioned, I am going to have a go. I've done some thinking about the macroeconomic and the monetary policy implications of Libra. And my starting point is the following quote from the Libra white paper that Mark already mentioned at the beginning. And in the white paper, it says that we believe that global, open, instant, and low-cost movement of money will create immense economic opportunity and more commerce across the world. I will try to deconstruct that sentence. I will use it as my starting point and have a look at what all of these things mean. Also, if you pay attention at the last bit, they talk about more commerce across the world, and I will return to this point whether Libra has a good grasp of the economic implications, the macroeconomic implications, and indeed, let me be a bit cheeky and say, having read the white paper, it's not clear to me whether they have a good grasp of economics at all. But as mentioned, this is a Silicon Valley organization. So in terms of my sort of some thoughts on Libra, I will leave it to someone much more eminent than me to talk about the benefits of Libra. And I think you're in trouble if even the US president doesn't like you. So these are a few tweets from President Trump, and on a more serious note, I think the very last one, where he talks about the currency, is probably most applicable to my bit of the presentation. Although he also talks about in the second in the top tweet on the right hand side, he talks about regulation and so on. So this also touches upon Aziz's part of the presentation. But it's the idea of Libra becoming another currency. And the attempt of Libra, or the possibility of Libra, of dethroning the US dollar as the world's reserve currency. So in terms of some of the regulatory and financial stability implications, Chairman Powell had a very nice testimony to Congress, and I'll leave it to Aziz to talk about all of these issues. I will focus mainly on the potential monetary and macroeconomic implications. And I came up with quite a few of them that I thought about, starting with, in sort of in no particular order. Libra has elements of a currency board arrangement. It's not a currency board as such, but as Mark explained, it's backed one-to-one by other assets. Now we know that a currency board can provide stability, and we've seen some very successful currency boards. HKMA is on the call, but we've also seen in Argentina in 2001 that there are issues with currency board type of arrangements. So is there a danger that Libra, given the way it's structured, is prone to some of these problems? If you remember the quote I showed you a minute ago about Libra wanting to have open, free, instant flow of money, is this actually something we want? And Professor Landau already mentioned this idea of frictions that may not be a bad thing. So do we, if Libra provides frictionless capital flows, what does that mean? And so we'll have a look at that. There's also an issue about Libra worsening global imbalances, and I will have a look at, or I'll sort of propose that Libra may have an impact on the supply or on the availability of global safe assets. Again, now we're talking about the assets backing the Libra Reserve, meant to provide stability to Libra. I'm also thankful to Professor Landau. He mentioned the IMF special drawing right, or the SDR. So Libra will be pegged to a basket of currencies. We have a reasonable knowledge of what these currencies will be. So the US dollar, the euro, the yen. So the closest equivalent would be the IMF's SDR. So we'll have a look at how stable the SDR is and whether a currency basket can really provide stability. Professor Landau also mentioned the idea of dollarization. So let me take that up and sort of have a think about the danger of stable coinization, which it's not my term, but it has been mentioned before, i.e. the idea that people will move from the domestic currency into holding a large amount of their assets in a stable coin. And then, I hope I'm not treading on Aziz's toes, I'll talk about global systemic risks rather than domestic systemic risk. So let me start with the currency board arrangement. And as Mark said, the Libra Reserve is backed by high-quality liquid financial assets denominated in a collection of stable currencies. And like a currency board, Libra will be created only when real money is exchanged and will be destroyed when a holder cashes out back into a fiat currency. Now, the document is a bit unclear of whether the backing will be complete or will only be partial. Now, a currency board will have to be fully backed, or we know that currency boards have to be 100% backed by the liquid assets or by the currency. Now, Libra says that the association will pay out incentives in Libra coin, as Mark said, to encourage adoption by users, merchants, and developers, which seems to indicate that the backing will not be full. Backing will only be partial. In addition, Mark also said that a supermajority vote can decide to either change the composition of the basket or can change the composition of the basket. And we know from economic history that any sort of rumors or any anticipation, whether true or not, of a change in the basket or how the currency board is going to operate can create a sort of a crisis of confidence in the way the currency board operates. So the fact that the backing is not 100%, and the fact that the currency basket underlying Libra can be changed is sort of a source of uncertainty. I think what's a bigger worry for me is this idea of redeemability. Again, Mark mentioned the idea that Libra, and they say in the document that they guarantee full convertibility at all times, or something along those lines, i.e., and this is the highlighted bit, anyone with Libra has a high degree of assurance they can convert the digital currency into local fiat currency based on an exchange rate. So Libra more or less guarantees that you will always be able to get in and out of Libra, presumably also in terms of high exchange rate volatility. Now the question here is that we've seen again in economic history that redeemability can be stopped. Most famously back in 1971, when President Nixon stopped the convertibility of the US dollar into gold under the Bretton Woods system, thereby hastening the demise of the Bretton Woods fixed exchange rate system. So it's not quite clear to me. There are potential dangers, potential risks in this basket of currencies not working as it's outlined in the white paper. Facebook or Libra may decide to stop redeemability or change redeemability just when users of Libra most need it and most want it. Let me move on to another topic, which is another statement in Facebook's white paper, which is that moving money around globally should be as easy and cost-effective as sending a text message, no matter where you live. So this immediately, to me, raises the issue of capital flows. And especially in our in SEACEN member economies and in the Asia-Pacific regions, capital flows are a big issue. And there may be instances where governments have legitimate reasons to monitor the flow of money in and out of their economies. Now, if there is a mechanism whereby investors or agents in the economy can bypass the legitimate or the regulated means of moving money out in and out of the country, I think that sort of causes problems, which I'll talk about in the next couple of slides. But one of the obvious question is, how would you put capital controls on Libra if and when needed? The Chinese have shown, one of the ways would be to just block the entire network, but it's not clear to me. Sort of Libra opens a way of moving capital in and out of the country without the possibility of any frictions in terms of capital flows. So the idea here is that, do we really want to eliminate all costs on the capital account? Do we want to allow the frictionless movement of Libra across the capital account? So if you remember at the very beginning, I said Facebook is thinking about commerce, but I don't think they've thought about. So they believe that Libra will be mainly used for purchasing goods and services. I don't think they've thought about the idea that Libra can be used for capital flows as well. So it's not that we're just buying our cup of coffee using Libra, or that I'm sending money abroad. That I'm doing it for purchases, but the idea of being able to send money abroad at no cost and without any impediments may well allow increased and a larger amount of destabilizing capital flows. And you can have a look at the slide. So the idea is that we may not want to have a world with frictionless capital flows, especially those that facilitate the hot money inflows, the portfolio capital flows, and that lead to very large and extreme capital imbalances. In light of what we've seen over the last decade, which is sort of atypical in the sense that theory would tell us that that capital is flowing to where returns are highest, we've seen over the past decade that we've seen that capital basically flows to wherever it can. So there's sort of very little economic rationale in the allocation of global capital. There's a search for yield. So capital is not flowing to where it's most productive, but it's flowing to where it's able to flow or where the penalties are lower. So maybe it is a case that we need, at least for some period, we need less capital mobility. So Libra could be a destabilizing force by reducing transaction costs on international capital flows. It may be a destabilizing force by enhancing capital flows, especially sort of flighty capital flows. Finally, let me move to sort of three other potential implications, which are the 3 bullet points at the end. That Libra may complicate monetary policy. It may be a pro-cyclical digital currency, and it leads to what has been called less locally compartmentalized financial risks. Let me just briefly highlight what these things are. So the idea here is that Libra will reduce the ability of central banks to tailor domestic monetary policy to domestic conditions. And this goes back to the impossible trinity in the sense that Libra, by allowing costless, frictionless capital flows, it weakens the third pillar of the impossible trinity, i.e., it will weaken the domestic control, the monetary autonomy for the central bank. The second point is the pro-cyclicality. In light of the fact that Libra allows for capital transfers of any amount of money, fractional amounts of money. So whether you transfer 5 euros or 5 units of your domestic currency, or 50 or 500, there's sort of no more, given that it's virtually costless, there are no more impediments, i.e. sort of transaction fees that would have prevented people from sending small amounts of money. Now Libra will collect, in terms of a crisis, if every person in the economy even sends 5 or 10 domestic units across, Libra will collect all of that, and what was a sort of a small atomized, a small quantum of a financial flow will be aggregated within Libra and can quickly turn into a large amount that would that may well have an impact on the domestic economy. The third point is that Libra, as we've seen, has 2.4 billion monthly users across the world, and it will work. It will link household sectors across borders, so it may very well sort of globalize particular crises. In the past, financial risks were segregated, but Libra may lead to larger, more unified crises across a wider variety of economic systems and balance sheets on account of some of the mechanisms I have described. Now, there are different effects on whether your currency is in the basket or whether your currency is outside of the Libra basket, and then also an effect on, as I mentioned, on the availability of the safe assets that back Libra. So a widespread adoption of Libra would increase the demand for the securities that back Libra coins in the reserves. What are these securities? Well, it's the usual suspects: US Treasury bills and bonds, German bonds, Swiss bonds, i.e. highly rated, highly liquid securities that basically everyone is after in terms of providing safety. Sorry, I'm getting ahead of myself again. The second point is, if you have a currency that is in the Libra basket, obviously in terms of the backing, Libra will have to, if you buy or sell Libra, there will be an equivalent transaction in the currencies in the Libra basket, which will experience upward pressure on exchange rates and downward pressure on interest rates. Now, I don't understand why anyone in an industrialized country would hold Libra. When you hold your domestic currency, you have a 1-to-1 exchange rate between your holdings and the exchange rate. Whereas if you invest your domestic currency in Libra, you're investing into a basket of currency that has volatility, and we'll have a look at that on the next slide. Now, economies with currency outside the Libra basket will have the opposite experience, i.e. residents will be more likely to sell their Libra tokens and buy Libra itself, assuming it provides a more stable value. So this is this stable coinization, in the sense that investing in Libra or holding your money in Libra is probably safer than investing in your domestic currency. Even so, the a basket of currencies is not necessarily more stable than any individual currency. So this is a very interesting chart that I took from Steve Cicchetti and Kim Schoenholz's Money and Banking blog, where they look at the SDR over a long period of time. So this is probably the closest equivalent to the Libra basket. So these are 5 currencies that are included in the IMF's SDR. And you can see that even a basket of currencies is quite volatile over long periods of time. So the black line is the level of the SDR versus the US dollar, and that has fluctuated between 0.95 and 1.6. And the red line is a standard deviation calculated over 5 years. So even this basket of currencies has a standard deviation of anything between 6.5% and 4%. So there's quite a bit of volatility even in a currency basket. And I'm not quite sure whether this is internalized by Libra. Now, why would it be unwise for any country not in the Libra basket to allow its citizens to use the currency? Well, if you shift away from your domestic currency, you will lose the seigniorage revenue that comes from issuing domestic currency, and for some emerging markets, seigniorage is a big revenue source. If domestic residents are transacting in Libra, i.e. they reduce the monetary base or the money supply, the central bank risks losing control of not only the country's monetary system, but of the country's payment system as well. And as I mentioned, acquiring Libra rather than domestic assets constitutes a capital outflow, which brings with it all the usual consequences, i.e. an increase in interest rates and reduced domestic investment. Now let me conclude by just mentioning a few issues. One is that Libra as an alternative payment will be a single source of failure. So if a lot of transactions are being done either domestic or cross-border, and I'm sure Aziz is going to talk about this as well, but in a cross-border context, a failure of Libra might have bad consequences. The Libra Association, as I said, guarantees convertibility into national currency, so it operates as an open-ended mutual fund, and the more people buy into Libra, the more Libra will have to invest in either these global safe assets or in bank deposits. So if there's a run on Libra, it may precipitate a domestic banking crisis if those bank deposits should be in jeopardy. And finally, just as a few housekeeping items, Libra does not have a global lender of last resort. So if something does go bad with Libra, there's sort of very little in terms of the safety net. There's no global lender of last resort, and Libra also does not have a deposit guarantee scheme. So just something to keep in mind. I went on for longer than I did, but let me just conclude with, I fully share this view of Libra, which comes from the FT, and they say that Libra is a glorified exchange-traded fund which uses blockchain buzzwords to neutralize the regulatory impact of coming to market without a license, as well as to veil the disproportionate influence of Facebook in what it hopes will eventually become a global digital reserve system. So very happy to discuss any of these points with you. But before we get to that, I'll turn you over to my colleague Aziz Durrani, who will look at the financial stability and regulatory implications.
Okay, thank you very much, Ole. And hopefully you can all hear me clearly, but in case there's any problems, just please send us a comment through and we'll adjust the positions. So I'm very much going to focus on the regulatory side of Libra. And Ole mentioned the blogs previously, and I've actually, if you want to look at it, I've written one on Libra, which basically takes apart many of the so-called foundations of the system, which Ole was just pointing to in that FT Alphaville comment. So I'm approaching this not from a perspective of supporting Libra in that sense, but it's more about the worries behind it. And I'm going to talk about the kind of overall regulatory concerns and split them into two areas, one on licensing and one on risk management. And you know, we've already covered during this session the various widespread concerns that central banks and regulators have put forward, whether it's around consumer protection, around the protection of financial stability and market functions, around market integrity and criminal abuse, and a whole host of other political, monetary, and financial stability concerns. But what I wanted to bring out is interestingly, yesterday we were at a talk at the Asia Business School, and it was about the future of central banking. And there were various people there, including many ex-governors of central banks and prominent professors and so on. And I raised this question of Libra. I think they can't hear me, so let me try and move. Should we swap places?
Yep. I think hopefully my voice will carry better if I sit here. So I raised the question about Libra and how worried they were about it. And I was quite disappointed with the response, because essentially they were saying, look, you know, it's not a legal tender currency. There's various problems with it and so on, which I all accept. But I think, you know, as central bankers and regulators, our world is the world of worry, and we should kind of look beyond that and see, well, what are the potential impacts if this takes off? And then it comes back to the tweets that Ole was showing in his presentation from Trump against Libra and digital currencies and so on. And I see this very much as a real clash between the old money, which kind of Trump represents, and the various you know, investment banks and industrial conglomerates that have set up foundation over the last 40, 50, 60 years. And then the new money, the kind of Facebooks, the Google, the Amazon, and there's a real competition here now to fight for the control of basically the financial system and money and so on. And let's not, despite all the problems I'm going to talk about that Facebook has and Libra has and so on, let's not forget that, you know, Facebook itself and the various other parties behind Libra, you know, PayPal, eBay, and so on, have billions that they're able to invest in the promotion of this potential currency. So, you know, I wouldn't put anything against them being successful, despite the number of issues that we're going to be raising. And just a third point I wanted to make is, we are obviously focusing on Libra, but it doesn't necessarily have to be Libra. So, you know, these issues and problems with Libra may make people think, oh, well, we've already got Bitcoin, why don't we use that, because it gets past some of these problems, potentially not all of them. But not only that, the head of FINMA, the Swiss regulator, just recently said, well, we're not so worried about Libra, because at least they're being open about these issues and coming out to us with this, but what about those other currencies and so on in the dark web that may develop behind the scenes and suddenly get market traction? So it's about the whole ecosystem really that we're looking at. So let me then quickly say, so the first you know, major point is around the currency risk. If central banks lose control of their currencies, and particularly in those countries where there is high inflation and fluctuating rates, then such stablecoin payments could be a much more simpler, reliable way for citizens to pay for goods, and it might start getting traction without any official sanction from
the government of the central bank. And of course, recently even Mark Carney, the governor of the Bank of England, stated that it's time to end the domination of the US dollar across the world. We need to look at other currencies and other potential solutions. And he's brought forward the idea that perhaps it is Libra or more likely another digital currency, perhaps run by central banks, but that could help transfer activities away from the dollar. And again, having a basket of currencies at its base. So this is potentially happening, and effectively, if Libra grows in the way that M-Pesa or Alipay or WeChat Pay have grown in China, it is going to pose fundamental challenges to governments, particularly those in poorer countries which have the weaker institutions. It could start to shift control of monetary policy away from governments to the Libra Association. And this is, of course, worrying, right? Because Libra is going to be a private company now, sitting between the central banks and the citizens, and having that level of control. And as Ole was pointing out, that will then eventually mean that those capital controls will no longer be a policy measure that's available to them, and that will lead to severe problems during economic uncertainties. And so it is something that we really need to worry about. So that's kind of the end game. But before we get there, there's a number of issues that Libra possesses. So let me go into some of those more regulatory focused problems. The first area is around licensing. So obviously we're going to need Libra to acquire one or even more licenses across a wide range of jurisdictions. They'll need to comply with existing anti-money laundering laws, countering the financing of terrorism regulations, and so on. They'll need licenses to provide payment services across jurisdictions, as this is normally a regulated activity globally. And some jurisdictions will also require licenses for e-money providers. So in the in the EU particularly, the financial legislation requires that. And then Libra may also require a banking license or other financial service provider related licenses in some countries. So because payments services are still limited to just banks in some countries, that may force Libra to have a banking license in order to operate. And then the second big area is working out, well, what is Libra, right? Is it money? Is it a currency? Is it a payment instrument? Is it a payment system? Is it a security? Is it a commodity, or is it a financial derivative? So depending on which direction that goes in, you could qualify it as compromising a commodity or a financial derivative. And then you see each Libra coin represents a cash flow right in the basket of cash that's on deposit in the reserve basket. And so that could be structured as a flow through, so like a collective investment scheme or a structured deposit, or as a securitization. So this will affect how it's licensed. And then in addition to any license that the Libra Association obtains, they would need something that covers payment services, a license as a commodity dealer in the US, and or as a MiFID investment firm in the EU. And this is very important. They definitely need this because we've seen with cryptocurrencies at the moment, it's the crypto exchange which is the real point of vulnerability, and so we need to ensure that that is properly covered off. And then Mark mentioned how the reserve pool is going to be set up, and we talked about it. We're not sure how legally it will function. So on the one hand, the Libra Association could own that Libra Reserve and manage its own assets, but this could be problematic because it would subject that pool to all the claims of creditors of the Libra Association, so any potential fines for antitrust, data protection, foreign trade violations, which could become massive in their own right, as well as their own tax liabilities. So that kind of structure, I think, would be unlikely. And I think what we'd see is the reserve pool would be managed on behalf of the Libra holders through an SPV or through a trust account arrangement. And so in this case, the Libra Association will need an asset manager license, or they'll need to employ an external asset manager. And then related to that, Libra will then require licenses for the custody and safekeeping systems, which underlie the link between the basket of fiat currencies. And again, these potentially could become systemically important as around the payment and settlement infrastructure in some countries. So those are the kind of licensing conditions, and then we'll talk more in detail about the risk management and how that would function. So first of all, there's the operational risk. So we want to ensure that the Libra Reserve is professionally managed, and we don't want to expose Libra holders from operational risk. And we then want to ensure that the Libra Reserve account is properly managed by the asset manager. So proper protections are in place to ensure that no one can then steal from that reserve portfolio, or even just kind of general errors generated when transferring fiat currency that's received from the Libra users and moved to the reserve account. The Libra net asset value for the reserve account will need to be calculated several times daily, accurately, and again ensuring that there's no ability for market abuse or insider trading or fraud or theft. And then again, so all of these mean that we need proper licensing in place, either as asset managers or investment advisors or investment fund managers. The second area is around financial risks. So we talked about the need to rebalance that portfolio on a daily basis. But you know, that's one thing in itself. But regardless of that, although we call it a stable coin, it's never really stable from every Libra holder's perspective. So even when the basket is properly diversified, the value of that basket will fluctuate in line with overall market swings. And we saw from Ole's presentation when he had the chart of the SDR, that also showed the volatility. And of course, how this fluctuation correlates with your home currency will depend on where you're from. So perhaps if you're in Venezuela, Libra is going to look relatively stable, but if you're holding the US dollar or the euro or the Swissy, then it's not going to be such an attractive perspective. So why would you want to hold it in that case? And that will affect you know, the risks you take on. And then Ole also mentioned the systemic risk. So if Libra does take off in the way that it potentially could, then we have various risks under the too big to fail and too connected to fail kind of scenarios, and therefore there's going to be microprudential and macroprudential concerns from both the perspective of the users who could be affected from the failure of the coin, but also the additional market power that the Libra Association will have, right? So they'll have these massive reserves, they'll be placing it as deposits at banks and so on. So suddenly that whole issue becomes quite genuine, and they'll have a lot of market power to force banks to give them preferential rates and so on. And so if suddenly that disappears or they need to pull that out, that's going to cause a much bigger run on banks. So I think given this situation, Libra would become a kind of crucial payment system provider or a bank, depending on how it's licensed. But it would need to be brought under the global framework that looks at the GSIFIs and systemically important financial infrastructures. And so potentially a systemic risk surcharge could be levied on it, similar to how we levy one on the GSIFIs. And then we also need to think about capital requirements. So on the first hand, there's the capital that's required to back up the actual stable coin. And we talked about this earlier. If the capital pool is going to be segregated, as it should be, then that will be sufficient, and no additional capital needs to be put up for additional liabilities resulting from the contractual obligations that will arise from the Libra holders, assuming that's properly done. However, the Libra Association will need to provide capital to ensure it operates properly. So given the large level of assets that will be held in the pool, you know, we think it's sensible to levy a capital requirement that's similar to what investment firms and fund managers have to hold for operational risks. because the Libra Association will be open to similar kind of issues. And then we talked about this earlier, the anti-money laundering regulations. So in all countries, regulators are going to require Facebook or the Libra Association to conduct AML checks on Libra users. And I think the Libra white paper includes a plan to check the digital identity of every user. So that in itself is quite useful. And if they can actually implement something that's relatively foolproof and works, then that could actually really help financial inclusion and other things. So there's benefits in that. But the problem is, once this kind of compliance is achieved, they will have overcome a major barrier to offering financial services to their customers, and Facebook and other people within the Libra Association are likely to want to start offering more of them. So that in itself will start creating other situations that we need to think about. Most importantly of which will be around the data protection issue. So this is really a major challenge for Facebook. And Facebook can really only leverage its client base for the initial contact to get that initial link. And so the Libra white paper has said Facebook has created Calibra, which we mentioned earlier, to ensure the separation between that social and the financial data, and to allow it to build and operate services on behalf of it on top of the Libra network. So initially, you'll need the customer consent to transfer that data. But there is this whole gray area, because there's no clear language that says, will there be permanent data separation between Facebook and Calibra? And there's real concerns that data pools are going to be mixed either with or without users' consent. And we know that is a risk given all these issues with Facebook's constant issues around data protection violations that have been coming through. So if those data pools are merged, Facebook would become incredibly powerful. They would have unprecedented insight into and control over their users' social and financial existence. And this is a real worry across all areas. And then finally, we have the tax issue. So we'll also have to determine whether VAT is to be charged on transactions, whether profits on the sale of Libra attract capital gains tax, and if further profits are generated from Libra's reserves, how are they going to be taxed? So this is one area, if a country does want to slow down the take-up of Libra, the tax angle could be a way of doing that. Because you could say, well, any profits on Libra would be subject to capital gains tax, and that could really slow the take-up of Libra. And again, in poorer countries, this could be an option for them, but once things move to Libra, it may make it very hard for them to actually levy this tax, and it depends on how powerful the taxation regime is in the country. So this is also, could be a number of weaknesses here. So that's broadly the kind of two major areas of risk. And then sitting across both of these is the whole question of cross-border supervision. Because Libra is obviously a global project. It's going to fall under many different national and regional licensing and supervision regimes. And so each regulator has something to say on how it will be affected and so on. And the risk is that in this kind of fragmented regulatory framework, it's going to lead to inefficient regulation. Now, one solution is substituted compliance, or in kind of European terms, what we call equivalence. So once Libra is licensed in one country and goes through those checks and so on, other countries recognize its supervision in the home country and reduce their own requirements. So this is something that happens in Europe. But it's not going to be as easy as that, because all the kind of major regulators want to have their own say on Libra, given how important it's going to be. And at the same time, we're seeing with the US-China trade conflict we're in a period where multilateralism is in crisis, and economies are pursuing a unilateral approach. So, even where central bankers are willing to adopt such a multilateral framework to ensure global supervision, it's not clear that Facebook would be able to fit into this. And even with the example I gave around the European Union and current supervision, apart from derivative regulation, that equivalence, for example, for European banks based in US, the US regulators don't recognize that European lead. So it's not even happening around the basic supervision, let alone Libra and the potential challenges it provides. So that's going to be another major issue and problem for regulators on Libra. So those are the kind of key regulatory concerns, and that then brings us up to our Q&A part of this session. Do you want
to? Thank you very much, Professor Jean-Pierre Landau. Thank you very much, Dr. Ole Rummel, and thank you very much, Aziz Durrani, my colleagues. Fellow SEACEN members, participants, if you have questions, we will take your questions over the next 20 minutes. The session is scheduled to close at 2 p.m. Kuala Lumpur time, which is 20 minutes from now. If you have questions, please send them to us. Professor, I hope you're still online. We know it's an ungodly hour to be up.
I'm still there.
Thank you very much, sir. We appreciate you still being there. I'm just wondering, since you're there, Professor, while we wait on the questions, because you did raise the digital currency area as possible way forward, and you did raise Mark Carney's intervention there. Given the conversation that we have had thus far, I'm just wondering, Professor, how should our members, or how should central banks contemplate some of these issues that we have raised this afternoon? Is Libra a wake-up call, as Benoit mentioned? Is Libra a wake-up call for us as central bankers? Do you have any thoughts for us, Professor?
Yes, thank you very much for the question. I do think Libra is a wake-up call. I do think it's only the harbinger of things to come. If I had to sum it up, I think traditional national currencies will face increased competition due to digitalization, and central banks and more generally governments and monetary authorities have to think on how they're going to react to that currency competition. I think they have the means to prohibit, to prevent, and to strongly regulate those monetary innovations. They can do it. They can do it easily because they have all the powers to do so, and most likely those private initiatives cannot develop and flourish if there's no enabling legal framework at the domestic level. The question is how far they want to go in using their regulatory and more generally their sovereign powers to do that. Because of course there's a lot of positive things in those innovations, and people like the idea of sending money in 1 minute at the other part of the world at no cost. They like it. They like the idea of living their life on a smartphone. They like the idea of dispensing with banks. All these are very popular things. And so there are trade-offs. And I think the trade-offs are very illustrated by what Ole says about capital control. So on the one hand, you want to allow people to make payments to their relatives across border. On the other hand, sometimes you want to be able to control movements of capital for macroeconomic and social reasons. So there are trade-offs. And I think my own personal answer to the question is that I think monetary authorities should embrace digitalization. They should regulate it, but if they don't embrace it, they will have to regulate it in a way which would repress innovation and ultimately reduce the welfare of the people. So they should both regulate it, but they should embrace it as well, which means that some kind of digitalization would have to occur in national domestic currencies as well. And that's, in my view, the main rationale for thinking very hard about issuing central bank digital currencies.
Thank you very much, Professor.
Yeah, can I follow up on that question? Because you had an editorial in the FT, I believe, earlier this year, in which you were advocating for a central bank digital currency. I'm just wondering whether this is sort of now a knee-jerk reaction. I mean, are central banks ready to issue a CBDC? Or is that sort of at the moment, would central banks be offering a second best alternative for now? I mean, are central banks ready to issue a CBDC, in other words?
Well, I'm not sure this is an urgent question. I'm not sure the question is not whether in 2020 central banks should issue digital currencies. But if you take a kind of decade-long perspective, a kind of long-term perspective, and if you assume that digital money will be developing and becoming a major form of money for the general public, then you're sort of faced with, again, I would say, three choices, and only three choices. The first is to prohibit it, which you can do. The second is to accept that all the digital money that people will use will be privately issued. And the third is to consider issuing your own public digital money. I think these are the three choices. And I'm just advocating the idea that central banks should keep those three choices open, and they should actively think about which form of money they want to provide to their general public in the 21st century. And if, as I assume, most of the money will be digital, maybe they should be able to embrace that. But it's not a question of tomorrow, you know. And we all know it's going to be a very, very difficult endeavor. But you cannot, I mean, what we see now is the private sector moving very fast with a very strong business model and trying to meet some kind of people aspirations. So the public policy response has to be devised taking account of that.
Okay, thank you.
Thank you very much. Aziz, I have a question for you. I think we have a question coming in from one of our colleagues on the other line, but I have a question for you before we come to this one. Are there any concerns on the governance side, Aziz, particularly when it comes to the different relationships within that 28 founding members of Libra?
Yeah, I think that's a great question, Mark, because there's a real worry, and I was kind of pointing to this at the start of my talk about who is really behind Libra, and we know Facebook is leading it, but the other kind of major players within Silicon Valley and so on, PayPal and eBay and various others, are kind of running it. So the idea behind the white paper is to say, okay, there's there'll be up to 100 different members. It's going to be quite well spread out and so on. But actually, the power structure is very concentrated in a few hands. Effectively, it's Facebook or those who will be using Facebook's business to a large extent. And so I don't think we can have any certainty that the governance structure will be kind of fair and equitable from the end user perspective. It's going to be very much focused in these private large companies who will be running it for their own good, or at least that's the worry.
If I can add to that, if I can add to what Aziz has said, I mean, just in terms of the sort of incentives, yes, you can have up to 100 partners in the association. Assume they do get 100 partners. I mean, how do you do governance with 100 parties sitting around the table, trying to find a consensus, especially for profit-oriented companies who are in it for the money? I mean, it's bad enough having a UN or the 28 members of the European Union trying to come to some agreement. But if you have 100 parties in the room, even with the existing 28 in terms of the incentives, every other member dilutes the power that the existing members have. So I think there's an incentive for them to set the bar very high in terms of new members.
Yeah.
And that's my second thought. And my third thought is, I mean, you have both Visa and MasterCard in the Libra Association. I mean, whether that raises sort of any competition aspects, that you have a potential global payment system that includes two of the largest payment providers.
Yeah. And we should point out that Visa, the cost for participating isn't much, right? So they only have to put up, what was it, 50 million?
10 million.
So it's a bit like keeping your name in there. And I think recently they've kind of slowed down, seeing the quite a high backlash against Libra. They've kind of been a bit more hesitant about supporting the organization. But you're right, they put their name on there because if it does take off, then they want to be part of it, and then it's going to be even more of a monopoly. So.
Okay, thank you. We have a question from one of our participants, and is, so far the expected impact of Libra has been speculation at best. And the question is, it's for all of us as presenters here, including Professor Landau. What do you think is a timeline where the issues will become less abstract and more concrete? Is it a few years? So in other words, the concerns that we have raised to say, well, perhaps today Libra isn't going to move forward. When will those issues be no longer an issue, and then we can move forward with something like Libra? I will share some thoughts, and then I'll allow the Professor and Ole and Aziz. I think the way Facebook and the Libra Association has gone about this, they have been relatively smart, because I think what they have done is they pitched something out there in mid-year 2019, say they're going to come live in the second half of 2020. And what they have heard over the last 2.5 months or so is all the concerns from all the central bankers, the academic community, and everyone. So they now have an opportunity to go back and rethink what they were proposing and to come again with addressing all the outstanding concerns. And if it is not Facebook and Libra, it is going to be someone else. So I think they have had free consultation as to what will not be acceptable by central bankers or regulators. And they are going to go and do their homework again, and they will repackage, and they will come again, or someone else will come again. So I don't know what the thoughts are from Ole and others.
Well, I would agree with you on that. I think I wasn't too sure about the strategy at first to come out with a sort of half-baked plan, and but I tend to agree with you that it was actually quite a clever idea, because I mean now everything is out on the table, and on the other hand, there are also some technical issues which, of course, they haven't thought about to any great extent. One having to do with the blockchain, which we know is inefficient, and I mean even if they iron out all the regulatory problems, I believe at the moment that the Libra blockchain can do 1,000 transactions per second. Whereas if you look at some of the big providers, I think for Visa it was 65,000, and I heard some number that WeChat or either Alipay or WeChat claims they can do 250,000 per second. So if Libra takes off, it's nowhere near the sort of efficiency. So in response to the question from our member, I think we're looking at sort of a medium term, 5 years, 5 to 10 years before we have sort of a working version of a Libra Lite that may be in use.
Yeah, I think my view is actually, I think it's going to be a lot quicker. So they've got this plan for 2020. They know what the regulatory concerns are, and I think these guys will move very quickly to start, scaling up and dealing with some of the regulatory objections. And it may not look the same as it's proposed in the white paper, but I think they'll get something that's working at least as a unit of exchange just on Facebook somehow relatively quickly, because I think we saw even the development of WeChat Pay and so on happened quite quickly. So I think it's already happening. They're already behind the scenes. They're meeting with individual countries and regulators. It's already, the Calibra Association is based in Switzerland. They've already put forward their plans there. I mentioned that the head of the Swiss regulator, FINMA, has already said, actually, we're not that worried about Libra because at least they're being out in the open. So they're already getting the buy-in from major regulators. Mark Carney has also said, actually, we're open to Libra. We want to, we want to see how it works. We're not saying yes to everything, but they are getting that traction there. So it's happening quite fast behind the scenes, and it's a misnomer to think that these are just kind of theories and that they'll float away. We need to be engaging with them now.
Professor Landau, any thoughts on that question as to how soon we'll see these things?
Yes, I think things may be moving very fast. Maybe not on Libra, but they may be moving fast on Libra, and I think there will be many other initiatives. And to be totally frank, I have the feeling that sometimes part of the central banking community has been a little bit in denial about what's happening technologically and the impact it will have on their missions and their responsibility. I'm not saying that central banks should dramatically change or take major initiative, but it would be dangerous, I think. And if I may say so, especially for medium and small size countries, to sort of dismiss this whole thing and think it's a long-term problem. My analysis, I may be wrong, my analysis are really a turning point or a tipping point in one of those technological innovations. And when you get on those things can change very, very fast, very fast. Let me give an example which is accessory to that, but which is very important, I think. It seems to me 1 year ago, 1 year and a half ago, when you were reading the literature by the BIS about the role of cash, and those papers sounded extremely confident in the preservation in the role of cash, right? Well, now, if I may mention my own experience, I was in the US like 10 days ago. I tried in a big airport to pay for a packet of chips, $1, $1.20, and cash was not accepted. So we are moving extremely fast, and those technological innovations, they occur with discontinuities. People are getting used again to have their life on their smartphones. I guess it's happening in every country, big or small, emerging, advanced, smartphones everywhere. And it would be wrong to be dismissive, and it would be wrong to be in denial, and it would be wrong to think that it's a long-term problem which does not need attention right now. Again, I'm not pleading for extra measures or dramatic decisions, but it's clearly, in my view, the beginning of major changes in the forms of money, and I don't think central banks can be indifferent to that.
Thank you. We are at 2 p.m. in Kuala Lumpur and out of time. There are lots of questions around Libra and what it means for financial systems and monetary systems. I will not close the session. I'll leave that to our director for MNPM. But before I more or less withdraw from the conversation, there are many questions. You have my email address. Please feel free to send them to me. I'm sure Ole will give Aziz and Professor Landau an opportunity to give their final thoughts as well. Ole.
Well, I couldn't have said it better. Let me start with my final thoughts, and I direct you to the last slide I showed you. So I'm not a big fan of Libra in terms of the sort of practicalities of the entity. Although I do hope, I share the view that it was a wake-up call. We've known for a long time that cross-border payment systems are inefficient, are costly. We haven't done anything about it. So there might be sort of low-hanging fruit in terms of improving, taking this as an opportunity to improve cross-border payments. And we've also, here I agree with Professor Landau. We've been a bit sanguine. So central banks have been a bit sanguine. There was sort of a bit of research into CBDCs 1 or 2 years ago, and that's been sort of that really, but not much since then. So maybe that provides us with another impetus to take the work on CBDCs forward. Now we don't need Libra for that, but we have to thank Libra for it. Any other final comments?
Well, from me, I would just say we shouldn't be, regardless of your personal views and the issues around Libra, as central banks, we need to kind of step forward and look at the risks now, because whether it's Libra, whether it's another currency or another solution, things are changing very quickly, and we need to be ready to adapt to that and have a way of reacting to these things and have sufficient people on board who can understand the risks and react to them. So we need to be thinking about it from now.
Okay, and last but not least, Jean-Pierre?
No, I think I would use my latest remarks as concluding comments, if you allow me to do so.
Okay. Thank you very much. Big thank you to all the speakers, especially Professor Landau, who can now have his breakfast. And big thank you to everyone who participated. I can see that we have 31 devices logged in. I'd like to think that there are many more people listening in. I can only support Mark in saying that please send us your questions. We will we will try to answer them as best as we can. And thank you for listening in. We will be back soon with another topical webinar. If you have any ideas for webinars, anything you would like us to look at, you would like us to discuss, please let us know. We are at your service. So between yourselves and us, I'm hoping that we can come up with another interesting webinar in the not too distant future. So thanks to everyone, and have a good day.
Thank you.